Hi everyone. Today we welcome Paolo Berlessa to talk about climate risk models. Paolo has a PhD in theoretical physics from the University of College London. For more than a decade now, he has been working on third and second line of defense roles in model risk management. And given that climate risk is like an emerging or has been an emerging risk asset for financial institutions, Paolo is very well placed to talk about the challenges, I think, of climate risk models. So welcome, Paolo, for this conversation. Really looking forward to it. Maybe to get started, you have a background in theoretical physics. So how does that help you to work on climate models?
Sure. Thanks, Jos. Thanks a lot for the invitation. It's a great pleasure to be speaking in this webinar. I think it's something that for me, it really it really fascinates me, and something I'll probably repeat a number of times. But when we talk about climate risk, this is a very broad area, which is actually nearly all-encompassing in terms of the underlying science. So there would be things from geology, biology, sciences, astronomy, to even like chemistry and quantum mechanics. So the spectrum of I would say discipline that are engaged in this studies is very wide, and anyone like who studied physics like us was probably in the first place was fascinated by those topics broadly, and then as you go into your undergraduate and postgraduate, obviously your area of focus becomes narrower and narrower, but that broad passion for science, I think, remains and becomes even more mature. So I think that's, in my view, the first thing or the most important thing that connects my studies to this area. In terms of the specific studies, obviously, I was actually touching on some climate physics aspect, but my work was on a very narrow, although it was quite deep, but a very narrow micro data point that then fits into the broader climate modeling. So I think no one can really touch on the whole end-to-end discipline. So it's more like a passion rather than a study.
Okay. And speaking as a physicist myself, one of the challenges or one of the aspects that I like a lot in physics is that you often need to model complex systems. And in order to do so efficiently, you need to find a way to understand what are like driving forces in a particular dynamic system versus what are maybe second or third order effects. Is that also something that can help in building climate models? Because again, here we are talking about an extremely complex system.
Sure, indeed, I believe that's one of the main areas of focus. So to understand, I would say, what is the key drivers of the warming of the atmosphere, and how those understand actually even the basically the linkage between causes and effect, because sometimes even the linkage is not very obvious. You see two things are correlated, but who's actually driving what might not be as straightforward. I think is one of the key challenges. I think there are some studies, or people are trying to study the Earth temperature going thousands of years back in history, in hundreds of thousands of years, and trying to understand how that correlates to uh, kind of the movements of the planets or the shape of the continents, etc. So it's definitely a lot of work on trying to figure out what are the key drivers uh, for and we all know that the our Earth atmosphere and temperature has been widely changing over the years.
Yeah,
So
yeah.
certainly something that it was discovered long before
Mhm.
we start worrying about the effect of the human impact.
Yeah, yeah, exactly. And so, of course, as I mentioned in the beginning, you work in the financial sector. So could you maybe comment on why climate risk models are important for financial institutions and how these models are being used today?
Sure. In terms of the importance, I believe I would say the primary need is to understand the impact of climate changes to the bank's operations. And also, I think it's also important for reporting purposes, given that there's a growing, I would say, interest from the societies, I think, all around the world in those matters. And normally within the bank's operation, the impact is split into two areas, the physical and transition risk. So normally, I would say the key usage or the key interest is linked to stress tests, trying to understand how the bank, I would say, liquidity, credit risk management, etc., will evolve over a number of pathways in the future. At the same time, there are, in some areas, I believe there are regulatory drivers. I think some regulators are head of waters and they require some specific disclosure. And I think one of the key needs in that regard is to trying to understand how each bank contributes to the global emissions. And for the banks, I believe the largest driver of emissions is not the direct emission of the operations of the bank, but is through the engagement with the clients, what is called the Scope 3 emissions. So the bank, in order to fulfill those regulatory disclosure requirements, need to have some sort of understanding how the clients' carbon emissions are compared to basically the bank portfolio products and loans that the bank has. So I think those are the key area where the banks are growing interest into the world of climate risk and climate modeling.
Okay, and maybe a few questions here. So you mentioned regarding disclosure, of course, of the carbon emissions. For a bank, obviously, the operations are not the main driver here, but it's rather the carbon emissions of the portfolio of the banks. Does that mean that you need to estimate the change in carbon emissions that has been caused by a transaction that the bank has executed with the company or with the entity, or is it more that you have to estimate the total amount of carbon emissions in that portfolio? Or
Well,
both?
it's actually both. I think the challenge here is on one end, the bank needs to be aware of the carbon footprint of the clients. But at the same time, they also need to understand how the carbon footprint is linked to the bank's products. So, for example, a bank could have a customer as a kind of very large emitter, but perhaps the bank products are only linked to a specific greening of the customer. So, I think they also need to build that additional understanding of what is the actual connection, what is the carbon footprint of the particular engagement with the customer, not just the customer by itself. And then obviously that needs to be linked to portfolio metrics to basically assess the overall performance of the bank within the purpose of greening the portfolio.
Okay, that's clear. And when you were talking about climate stress tests, of course, climate impacts that portfolio in a variety of ways, I imagine. For instance, if say overall temperature rises, the efficiency of an energy production plant might drop, but also if you get rising temperatures, obviously there is a higher risk of flood and probably also, and most likely as well, a high risk of of natural disasters. No, these both are like global or more global type of behaviors, but also extremely local ones, right? If you are impacted by a natural disaster, probably your location will be very important to estimate the probability of such event happening. So does that mean that even in those stress test models that are being developed, that you have to manage both the global and the local scale?
Yes, that's right. I mean, the stress test in the world of climate risk, we don't really talk about scenario, but it's the word which is used is pathways, which is normally a combination of depends on the horizon on the stress test. Obviously, on the short horizons, I think the emphasis is more on the natural disaster or the changes in the natural patterns or the weather patterns, to be precise. I think on the medium and longer term horizons, there is also an inclusion of the human activity, how the societies and the policies gonna basically change over time, which may have also an impact on the bank portfolio or loans. So depending on the horizon of the pathways, we have more emphasis on one or on the other aspect of the future forecast. Now, in terms of you ask about the weather forecast. This is something that I think is becoming, unfortunately, as we witness on the kind of not daily, but quite frequently in various parts of the globe. We are becoming more and more exposed to those extreme events, or something that was not related to previous experiences. And therefore, we can see that the number of damages, et cetera, et cetera. So that is definitely within the bank interest to trying to understand how to connect those events to basically credit risk, liquidity risk, market risk, which are the standard, I would say, metrics or risk measures within the banking world.
Okay, and one other risk metric that you haven't mentioned yet is like regulatory risk. To what extent plays that an important role in especially like long-term predictions that are being used? I give you an example. In Europe, there is something which we now call EPC risk. What that means is that in the near future, it will be mandatory that, say, a home has been properly isolated and that it has like a quite efficient energy management. Otherwise, it will be impossible to sell the property. So obviously, if you are building up a portfolio of mortgages as a financial institution, the value of the collateral is going to depend heavily on whether or not you reach this EPC threshold or not. And if you wouldn't reach it, then it means you will have to invest in the home before it can be sold. This is like an example of what I would call more like regulatory risk. Is this something that you also witness globally, these type of additional dependencies?
Sure, and I would like to add that in addition to regulatory risk, along the same lines, there's also societal sentiment. So whether or not the regulator prohibits a certain trade, it could just be that the people are not ready or not willing to buy those type of houses unless they see a certain level of quality in the isolation, etc. So all these things are definitely part of the socioeconomic pathways. And but at the same time, I believe that, and obviously there are different pathways that people trying to basically predict, say the speed of introduction of those requirements, or where the requirements will drive the economy. But at the same time, I think that's also a little bit clear in the sense that we have a sense of direction from all the regulators, etc., on what the future looks like. So we just need to be concerned exactly how the timeline of those interventions, but I think we are quite certain that all societies will move along those lines over the next few decades.
Yeah.
And another area which is also very important here is technology advances that may create new business opportunity, at the same time may make some businesses become obsolete. So all these I would say, are included to some extent within the socioeconomic pathways that are used for the stress test.
Okay, that's extremely interesting. Now, what is clear from this discussion, of course, is that when we talk about climate risk models, first of all, it's like a large collection of different models, and moreover, since the climate is very complex and an extremely non-linear and I guess almost sometimes chaotic system, modeling that presents a number of large challenges, I would say, right? And then on top of that, the amount of data, the amount of meteorological data, but also probably like historical data that goes into such a model is tremendous as well. So where do you actually start if you need to build a climate model? I would imagine that in many cases you start from something that is already existing, but even suppose that we were to like start from scratch, how would we do this?
I think you mentioned at the start that those models are effectively a collection of models. So I don't think there is any single end-to-end, but there is a number of quite a large number of models that touch on different areas of the I would say of the pathways that then basically contribute to create the final scenarios, which are included in the which are basically usable by the banks, etc. And no model can be, in my view, have any real use unless you overlay it with the socioeconomical kind of considerations, which we mentioned earlier. But in terms of building the models, normally I think those are trying to model the atmosphere as a grid. And obviously the fineness of the grid, it really depends on your computational ability. And they normally, I believe there are two types of models. Models trying to look at the Earth in its entirety and trying to look at the overall energy balance and trying to basically model how much energy comes in and out to see what is the basically increase in the overall temperature, and models that tend to be more kind of regional focus, where they are basically concentrating on a particular region and trying to basically model I believe, the fluidodynamics of the atmosphere, basically through a numerical simulation on a grid. But at the same time, I think another thing to highlight in my view, which is quite important, and you also mentioned earlier, that some of those events tend to be extremely localized. So even though we can have conclusion on average on how much rain or much sun exposure would be on a certain area, they tend to be very focused on a smaller area within the bigger area, which is what makes the impact extremely unpredictable and chaotic of those phenomena.
Mm-hmm. Okay, so what you're saying is you build, well, it's like a gigantic partial differential equation, I guess, that you need to solve. But you first build, say, this large-scale model which tries to predict how the energy balance of the Earth evolves. And then with this as some sort of like basis, you would then maybe model on top of that probability of, say, natural disasters that might happen in a very specific location. Should we look at this in this way, and this having those two layers almost of like first global baseline and then local predictions on top?
Yes, I mean, that's right. I think there is a number of parameters that are used within I would say, the regional modeling, which come from those macro models. And you also need to take into account, as I said, this pretty large grid of partial differential equations. And you need to basically take them into account, trying to build the boundary conditions and then do the diffusion on starting from that. And then obviously the results can be I would say the more useful, the finer the grid that you are
Mhm.
capable of doing that, but also the better the initial data or I would say kind of measurements that you have available to you.
Mhm. And as a financial institution, how do you work with those models? Should we think about it like almost vendor models that are maybe being fine-tuned a little bit towards the specificities of the financial institutions, a bit similar to how most companies nowadays work with large language models? There's not too many banks who have developed their own LLM, I think. Or are there specific model types perhaps that banks do develop internally?
Yes, I think that's a very good question, and I definitely, I think unlike LLM, where although it's extremely unlikely, I see maybe that the bank might try to build its own LLM
Mhm.
language, but I think for climate models, that is nearly impossible because
Yeah.
as we mentioned earlier, the chain, the model chain that basically leads to those pathways is extremely complex. And there are many companies and intergovernmental institutions nowadays that actually are fully focused on those services. So I don't see the bank having any ability to actually bypass the need
Mhm.
to engage with those companies. And from that point of view, it kind of raises a number of questions on the principles of model risk management, because
Exactly.
obviously the expectation that the bank can really be on top and understanding what is being fed, I believe it needs to be somehow reassessed, because there would be I would say, hard boundary that will be unless you build a kind of a small, well, quite a large research center,
Mhm.
you will never be able to kind of understand or challenge the numbers provided.
Mhm. Yeah, exactly, which was indeed one other question that I had in mind. If these are indeed like vendor models, then from the point of view of model risk management, we need to start looking into third-party model risk management, really, which comes obviously with a whole lot of different challenges. Like how to understand properly that a model is fit for purpose as one example, understanding how that model has been built, what data has been used before, and also, of course, measuring or monitoring that model as it is being used. These are a wide spectrum of challenges that are the same for basically any vendor model, but in the case of climate risk, I guess, given the complexity of the model itself, and as you said, almost the impossibility of running such a model and training such a model on your own, there are obviously a lot more challenges here. So maybe if we start with the most straightforward question first, suppose I'm a financial institution, I selected a climate model that I will be using for the stress test reporting, for instance, towards the regulator. Now I need to monitor that model first of all, right? As it is being used. What exactly can be monitored for such a system?
Sure. I also would like to highlight that in this case, we think about third-party models, but then I think if we deep dive, we'll basically quite always, I believe, find out that that company itself has a fourth-party model, which then has a
Yes,
fifth-party model, and there's quite
exactly.
a long chain of models which are so
Mhm,
that even the company that provides the third-party model might not be able to demonstrate how the
mhm.
fifth-party model works or whether it
Yeah, that's
works
a
or
very good point indeed. It's
not. So
yeah,
in
it's a
terms,
recursive third-party model risk.
yes, in terms of the monitoring, obviously in the short term, we can always kind of relate to the, unfortunately, as I mentioned earlier, we kind of are experiencing some of the impact of those climate changes. So we can certainly relate past events to what the forecast predicts. I think on the longer pathways, where we also include socioeconomical consideration, etc. Obviously, I don't think there is much you can really backtest, but just basically wait, gather the results. But what can certainly be done is to compare perhaps different vendors, different scenarios, different models to basically trying to gauge the uncertainty or the stability of the models or the prediction to compare to the basically the assumptions that get into the model itself.
Okay. Now, if we are monitoring models, depending obviously on the type of model, certain metrics can be reacting rather more quickly to, say, to highlight deterioration, say, in performance, while other ones might take more time, right? I'm thinking about, for instance, on, say, traditional credit risk models. If your model predicts the risk of default over a 1-year period, it's very hard to use, say, the precision of that model on a day-to-day basis to see how it evolves, right? Because typically you would have to wait for a certain amount of time until you will see some of those defaults realize, especially if you have like a relatively low default portfolio. On the other hand, you can also, say, monitor the data that comes into the model and try to detect if there is shifts in distribution of the data, which might be a more leading indicator, something that can help you to detect issues earlier on. Is there also something similar for the models that we are discussing now? So you mentioned, for instance, like the probability of natural disasters as one topic that you can monitor, but would there be other indicators that can be monitored that would be able to capture changes in the model behavior earlier?
Yes, also let me highlight that unlike the credit events that you mentioned, I think we also here talking about data which are perhaps not even accessible or measurable by the bank, because the bank may not have that ability to measure the rainfall. Obviously, there would be a different provider that provides the data. But I think the whole point of stress test is to create pathways as opposed to basically create something that can be back tested. In my view, what is the challenge here is to actually make that move from that jump from basically a stress test, only stress test focus consideration to basically include those consideration on climate changes into the day-to-day activity and risk metrics of the bank. So when we talk about the credit risk or portfolio, how that should be enhanced or should be changed if we also add climate change consideration. I think once you get into the step, then obviously you will have a number of metrics that can be directly measured and back tested on which are more aligned to the traditional metrics that the bank is basically well kind of formed to measure.
Okay, that's clear. Maybe another question on, especially as you mentioned, stress test models again. One of the challenges or interesting topics, say, on stress test models is obviously how to provide scenarios, or in this case pathways. Given that these are very complex models, they have, I believe, a huge amount of inputs. Could you explain a bit how this process works if you receive a pathway or a scenario from the regulator? I imagine it will be given in terms of a number of points, but then you have to probably generate a lot more inputs to the model in order to be able to use this pathway or this scenario. So you already need like a first model to complement the scenario before you can use it. Could you explain how that works in the case of climate risk models?
Sure, I think that's kind of more broadly how it works in general, because obviously the regulatory scenarios, when they are available, and I would say, not forget that there are two types of stress tests. I mean, there are stress tests which are kind of driven by the regulator, where they provide the scenario, but also stress tests that need to be basically derived internally. So the regulator just gives you a request. So if we're talking about the first type, where we need to basically align to a scenario already provided, and normally there are two steps which are needed. I think one of them is to interpolate and extrapolate, because most of the times obviously the data points are not aligned to the needs or to the products, etc. And also most probably there is the need to basically figure out a correlation or linear correlation with total variables which are not provided but essential. Actually, the ratio between those two sets, I mean, I would say the provided variables and needed variables can also be very large, in the sense that we are providing a handful of variables, but unfortunately there are like a need. Obviously, the more complex the bank, the more complex the portfolio, I would say, the more the risk drivers, and therefore the larger is the need to basically figure out those correlation, and just through simple linear correlation, trying to build those additional time series that are required in the stress test.
Exactly, but to your point, this is something, this is a procedure that is common to all stress test models, probably. But in the case of climate risk models, since the data sets are that big, and since, as we discussed, this is like third, fourth, and fifth party model risk related, is it easy for a financial organizations to fully understand what's the proper way of creating that scenario in the first place? Is there anything specific to interpolating and extrapolating the scenario to be used in a climate risk model that would be not there for other types of stress tests?
No, I think what's happening, in my view, the complexity of the risk drivers, so basically an understanding of what are the key risk drivers, both economic or climate risk drivers, it's evolving. So the more the bank is able to basically expand on that, obviously the more complex will be the approach. But and also depends a lot on the bank's portfolio. I think a very large global bank will be impacted by climate all over the world, whereas a smaller regional bank may also be impacted by a very homogeneous set of data. So that also makes a huge difference. But yeah, I don't think there is any real, I would say, difference at the moment in the approach, given that perhaps the inclusion is not yet as sophisticated as one would hope.
Okay, but of course, we expect that this will evolve over time, right? Which brings me to the last question for today. This is obviously an evolving field, and there is many challenges that are still there. Could you comment perhaps a bit on what are, say, the major challenges according to you in this field, and where you believe the field will be in a few years' time?
I think in terms of the challenges, it's probably much quicker to say what are the resolved challenges, because I think there's not much that can be claimed as resolved. I think if I look at the credit risk management or liquidity risk management, those are extremely well-established processes. But this is a completely new area. And in my view, what are the challenges now? I think one of them we already mentioned, which is to exactly integrate the model risk management or those models within the model risk management, let's say, framework and policies, and to understand what is the best, most effective, and also achievable way to basically manage the models. And secondly, I would say another challenge is to develop the data that are required to basically support the introduction of those models, because we talked about the pathways on one end, but on the other end, the bank, in order to deploy those pathways to its own portfolio, needs to have a number of data points that are not necessarily historically required. And you mentioned, for example, you talked about the insulation of a house, which may impact the sellability of the same property and therefore the LGD. I'm not sure that if you look at the portfolio of mortgages that the bank has in place, they have that piece of information. Similarly, I think the banks engages with clients, large clients, but to know exactly where the factories are, what is the kind of the production chain, etc. I don't think the bank has in full those information. So there's definitely a process to start acquiring those data, which then will be linked to the pathways that we mentioned. And I think the third area that I'd like to also discuss in terms of skill set. I think while we said that the bank will never be able to kind of replicate a full research agency, but I think there is the need to find a more scientific skill set, and that will help also kind of percolate those models into the daily activity of risk management of the bank. I think those are the three key challenges that, in my view, are facing.
Okay. And do you expect that, say, machine learning and AI in general will have a role to play there? I think we've all seen recently that DeepMind launched a new model that is able to do like a weather prediction at a global scale, which is driven by, I believe, a deep neural network. Do you expect these type of models to play a more important role going forward?
Certainly, I think they definitely are going to play a role. So surely they will play in this area as well. And I think not just if you look from the top down, but also from the bottom up in terms of understanding the credit profile, etc. It could be that the machine learning models will be able to establish the connection with the climate risk drivers on a more effective and fast way than the traditional approaches. So I think it's definitely worth trying, and I believe that they will certainly bring some innovations they did in all other areas.
Okay, well, thank you so much, Paolo, for this conversation. What I particularly liked is that we were making the connection between, say, how to build these models from first principles towards where are the challenges when it comes to model risk management, which obviously is an extremely interesting topic, and then to basically realize that this is an extremely wide, open, and interesting field where there is still a lot to discover. So I'm sure in the coming years we will see many interesting modeling techniques coming up. So thanks again for this really interesting conversation, and yeah, let's see how this field evolves.
Yes, thanks a lot for the invite. Yes.
Thank you.